I wanted to introduce our next speaker, Selwyn Gerber, and I just wanted to say a few words only because the most important mentor in my whole career was in medical school, and he was a surgeon from South Africa. So when I first met you, I instantly loved you because you remind me so much of him, and you have the same, you're the consummate gentleman, you have that same kind demeanor, the professionalism, you're incredibly intelligent, and everything you've ever said has been so wise. So I think we're all very lucky to have you here, and maybe you could share a few words of your wisdom.
Thank you. Thank you so much for your kind words. By the way, I just want everybody to know that Jonathan and I wrote a book on investing. It's called The Wealth Blueprint. We bought a copy for everybody. Please make sure to take it on the way out. It's got a lot of wisdom. It's not our wisdom. Our job isn't to generate wisdom. It's to find out where it is and make it available to our clients and incorporate it in our lives. So you'll see a lot of stuff here. We sit on the shoulders of giants, and you'll find out who the giants are. One of them died this week, as Jonathan has said, Charlie Munger. We also, Jonathan and I, prepared for you a year-end tax and estate planning checklist that you should take with you. If your CPA doesn't do the stuff, you should probably fire them. By the way, we're not looking for clients. I'm serious. But find somebody else, anybody else. If they're not up to speed on every issue here, and hopefully haven't proactively suggested it to you, it's probably time to move on. I always tell people, if you're the one making suggestions to your CPA, you're probably with the wrong person. We also prepared and Jonathan alluded to this, there are going to be some big changes in the estate tax rules. And here are some specific things that you can do in advance of the reversal of the tax cuts in the estate planning area. So I wanted to give you an overview of the economy as we see it. I want to start off by making sure that everybody understands clearly that we are very bullish. We are very optimistic about the American economy. We love America. We don't diss it. We're immigrants. And I always tell people, if you don't think this is an amazing country, go elsewhere for 6 months. And so I'm going to start off with all the good news. People have called us at RVW the Perma Bulls. And actually, as you'll see, it's a pretty good place to be. Being bullish has been pretty good. As Warren Buffett has said, for 200 years, the American economy has been the goose that laid golden eggs, and it's unlikely to stop in the near future. And we believe that. So all we want to do is show you why we're optimistic, and then some ways that you can harness the golden eggs that this country has and will continue to deliver. Now, my big challenge is, perfect. Okay, so first of all, let's look at the macro picture. This is all good news. Because, you know, the world is full of bad news. This stuff doesn't make headlines. That's the problem with good news. It doesn't make headlines, but it ought to. And it should make headlines in every one of our lives. So first of all, the number of people living in poverty in the United States and worldwide has plunged. Even the poorest people today live better than the wealthiest people did 100 years ago. Just in terms of, you know, the global situation, it's pretty darn good. Secondly, people talk about the Green Revolution. Take a look at where the United States is in the world relative to India, China, and so on. Look where we are. We're driving Teslas and worried about plugging in and so on, as if we're major culprits in the global pollution problem. We are not. We shouldn't feel guilty. We should be damn proud. We are one of the smallest polluters on the planet relative to what we produce. I give this to you because this doesn't nobody walks around talking about how incredible the American efficiency is relative to the utilization of fossil fuels. It's unbelievable. We are hardly producing anything of consequence. And if you look at the people who are the real culprits, just look towards the left. Look at the colors on that slide and you can see it. Now, one of the mega trends in place is technology. One of the reasons why we're so bullish and so optimistic is because we are in the midst of a digital revolution. And that digital revolution just got new tailwinds with AI, artificial intelligence. And those two together are going to add enormously to the productivity, the profitability, the economic vibrance of the United States. Just one example, McDonald's now has robots making hamburgers. You can go into McDonald's, press the buttons for what you want, and take a look. There's Flippy making hamburgers. This is America. Folks, this is America. Better than ever. Now, take a look at artificial intelligence. Just give you a sense of this. Take a look at the months it took to reach 100 million users and see how long it took for Uber, Spotify, Instagram, TikTok, and ChatGPT. Look how quickly the adoption was. of ChatGPT. There are, I don't even know the number, but there are enormous numbers of people now using it. And it is transforming everything. I will tell you that one of our clients is a deal junkie. And I had lunch with him a few weeks ago, and I said, what's going on? He said, well, AI has changed my life. Generative artificial intelligence. And I said, how so? And he said, well, I don't sign an agreement anymore before running it through ChatGPT. I said, give me an example. And he said, well, I just did a non-disclosure, an NDA, a non-disclosure agreement. I ran it through ChatGPT this morning. And it came up with about 10 different comments. Geographic limitations on the definition, the geographic limitations on the application, the specific limitations as they were, the definitions, every single aspect of it, the duration, every single thing, it had a comment or a suggestion. So, you're seeing huge, huge changes in every aspect of society. And this whole digital revolution, as I said, enhanced by artificial intelligence, is doing to the economy what electricity did 100 years ago. So, there's no ChatGPT or artificial intelligence sector. It's core infrastructure that is changing everything. And the companies that we own will benefit from this. That's why profit is so high. That's why they just announced today that the quarter ending September had a massive increase in productivity. Massive, over 5% for the quarter. Broke all records. Today it was announced that the September results were so positive. That's really important. And why? Because of the digital revolution that's transformed everything. By the way, we're doing darn well. The GDP, which is the gross domestic product, the measure of economic activity, look what it's expected to do over the next 4 years. Terrific, absolutely terrific. By the way, if anybody's speaking, it's really disruptive. I can't even tell you how disruptive it is to my brain. Take a look. People were worried about inflation going up to 9, 10, some ridiculous percentage. Look, it's all benign. It's all benign. We've solved the inflation problem. Interest rates are coming down. The excess funds have been processed and absorbed. It's not going to be clear sailing all the way, but look at the trend. It's clearly in a positive direction. And by the way, as inflation comes down and as the economy strengthens, profits grow, what do you think is going to happen to the stock market? It's got only one way to go. Now, it's not going to go there in a straight line. I'm not going to tell you that, but I am going to tell you that over the next 5 to 7 years, 10 years out, the stock market as a whole will do really well because all the tailwinds are pushing it in the right direction. That does not mean there won't be bear markets and interruptions between now and then. But if you look at major chunks of time, and I'll show you that, you'll see why we're so bullish. I want you to know that the talking must stop, please. It's really, I've got a brain that's very weird, and it actually sounds louder to me than it does to anybody else. I really don't mind if anyone wants to go out, there's a large patio, but it has to stop, I'm sorry. The American consumer runs the show in America. The American economy is 70% consumer driven. If you want a shorthand or quickie way to see the direction and the health of this economy, look at this chart. Take a look at this chart. First of all, I know you're not accountants, but take a look at the balance sheet of the American consumers. Look at the size of the assets compared to what they were in the third quarter of 07, 85 trillion. Look at them. Look how positive they are relative to the liabilities. You don't have to be an accountant to look and see that this is a healthy balance sheet. Assets way in excess of liabilities. And delinquencies, although they're a little bit up on the right, I think I've got a thing that actually may even, there may even be a, is there a laser point? Maybe. Oh, okay, perfect, there we go. Fabulous. So you can see some of them are inching up just a little bit over there, but basically they're down. We have very little in delinquencies, and our household debt service ratio, which is the percentage of income that households are using to fund their debt service, take a look at that. Very low. It's been much higher. This is a healthy state for U.S. consumers, and U.S. consumers run 70% of our economy. That's a good picture. It's a very good show. Take a look at corporate earnings per share. This is a fantastic picture. Look at it. The earnings drive the stock market. The earnings are a reflection of economic prosperity. That's what's going on. Now, people get very upset and worried about the non-financial credit market debt. In other words, how much debt does the country have? And the doom and gloomers, of which we are not one, But I will tell you about doom and gloomers. They come around all the time. And the problem with them is they're like a broken clock. They get it right once a day. But that's it. Other than that, so don't be fooled by the doom and gloomers. When you see this chart, you'll think it's absolutely terrible that the debt, the non-financial credit market debt, the debt in this country is enormous. But let me just show you the other side. They don't look at the assets. And when you put them together and you see the assets and the liabilities, then you understand context. And I always tell people, text out of context is pretext. Think about it. If you don't see the whole picture and you don't think about it as an accountant, well, what does a balance sheet look like, assets and liabilities, you think we're in trouble. And that's what you read on the news every day. Take a look at the cost of servicing, Take a look at the cost of servicing debt. Take a look there. Hold on one sec, sorry. This is the one I was looking for. The cost of servicing debt is very low. And most corporations have tied up long-term debt at very low interest rates. When interest rates were close to zero, most of the corporations were issuing long-term debt at very low interest rates. So they're stuck at even though rates have gone up, they haven't felt it. And households haven't felt it either because everybody with a brain refinanced into a new 30-year mortgage at, something close to zero. So we don't have a debt problem. We don't have an interest problem. Now take a look at corporate profits, and you see it over here. Once again, pre-tax corporate profits, pretty much mirroring the earnings per share that I showed you earlier, a sign of great health. Now, this is the secret that nobody talks about. This is people 70 years and up and the share of household wealth that they own. Take a look at this and you'll see that it's growing rapidly. This amount of wealth over here, number one, means that it's going to cascade down to the next generation in the next decade. There's going to be a huge cascade of accumulated wealth to the next generation. That's all the way down. And by the way, they also are big spenders. They don't need to save anymore. And they don't have much in terms of costs. Most of them have low mortgages. They don't have big debts, big obligations. The kids are off their hands. So they're big consumers. So that's good for consumption. And it's good for generation of wealth to the next generation. This is a very powerful force that will be unleashed over the next decade approximately. I now want to talk about the stock market. And you'll understand why we are mega bulls. Perma-bulls, we call it. First of all, take a look at Take a look at what happened to $10,000 invested in 70. And take a look at all the bumps along the way up until they finally got from $10,000 to $2.1 million. That's what happened. Now take a look at all the bad news. Every vertical line, every one of these, every vertical line is a big dose of bad news. And if you turned on Bloomberg or any of the financial channels or read the newspaper, what you'd see is doom and gloom. Bad news is on the way, some catastrophic event, and the market's about to plunge. Do you know that this year, 2023, was the most widely anticipated recession and bear market in my memory? And I've been in the equity business since I was 14, when I bought shares with my then economics teacher in South Africa, in Cape Town. When I was 14 years old, I bought shares. There's nobody else who's 73 years old who started this business when they were 14. I have a long track record. When I was at college at the University of Cape Town, I was selling mutual funds in first and second and third year business. I've been in this business. I've seen more recessions, more depressions, more bear markets than almost anybody you know. And I'm telling you, this was the most widely anticipated recession in my memory. People didn't think there was going to be a recession. They knew there was going to be a recession. They didn't think there was going to be a bear market. They knew there was going to be a bear market. And virtually every month you find another hedge fund that took a huge short position, confident that there was going to be a bear market, and folding up. And you can. What happened? So why wasn't there a recession yet? Or are we? I'll tell you exactly why there wasn't a recession. First of all, we know why. I would be interested in what you think. Tell me. Sorry? Very good. By the way, I just found out she's the person of the year on Time Magazine. There you go. No. The recession actually, first of all, let me start by saying this. The function, and I'm going to quote one of our mentors, Warren Buffett. Warren Buffett's words, the function of economic forecasters is to give credence to the profession of tarot card reading. That's what Warren Buffett thinks of economic forecasters. We do not live in the world of forecasts or predictions. We live in the world of current data. That's the first answer. But the second answer is if everyone expects a recession, they prepare for it. And it doesn't happen. When companies are expecting recessions, they pull in their belts. They cut their costs. They cut their inventory. They're more aggressive about managing receivables. They do all the things necessary to avoid the bad news. And in a sense, the bad news is avoided by the entire economy. But why doesn't bother us as much as what? And what happened? We had an amazing year. Stock market is extremely strong. The economy is good. Is it soft landing? Of course it is. And the headline of our last report that we sent out to our clients at RVW was, it's still a Goldilocks economy, but the porridge is beginning to cool. And that's what we see it as. But no bad news, no terrible. If the economy slows down, as you'll see, we've been through that before, we do just fine in recessions. First of all, even in recessions, there are many companies that do really well. You should remember that in a recession doesn't mean every company does badly. There are many companies that do very well in recessions. And they pass, which is even more important. And the other thing is, once you get humble, you can't predict when they're coming or when they're going. Otherwise, you get into the market timing and prediction business, and that leads nowhere good. So let's take a look at this slide. I think it's a very important slide. I made a statement before that I stand by. Jonathan stands by, our whole RVW team. By the way, do you know why we called it RVW? I'll tell you why. Because I read an article 25 years ago, and the article was headlined, is it possible to build a Rip Van Winkle portfolio? And I read it and decided I was going to start a business called RVW that was going to do exactly that. To build a portfolio where people could sleep peacefully for good reason. Not because they're taking tranquilizers and sleeping pills. They could sleep because they have the most valuable commodity you can have as an investor, peace of mind. And you'll see on our logo, because peace of mind is everything. That's what we're in the business of. We're not in the business of managing money. We're in the business of providing peace of mind. And managing money is part of it. Holistic, contextualized wealth management. Contextualized to your situation. Holistic because it takes into account everything. That's the business we're in, RVW. And this is why. So take a look at this. You will see here the history of bull and bear markets going back to 1942. And let me tell you what you'll see if you look carefully. You'll see that the blue lines here, that's a bull market. The orange lines, that's a bear market. Now notice the width of the blue and the orange, which means the period, the time frame. And you will see that bull markets are way more broader and more and wider. They're much wider and therefore much longer in duration than bear markets. Not only that, if you look at the height of the blue versus the depth of the orange, you'll see that when it is a bull market, it's far larger in financial consequence. In other words, if you were a printer ordering ink to print these, you'd be ordering probably 10 times as much blue ink as you would orange ink, which makes the point precisely. And so what you see here is, and it's only a mild exaggeration to say, that the entire history from 1942 until now is one long bull market, interrupted by occasional bear downward spurts of a bear market. By the way, does everybody know why they use the word bull and bear for the stock market? Bull markets are generally used when the market is going up, and bear markets when it's going down. That's because when a bull kills its prey, it comes from underneath and lifts it up. When a bear kills its prey, it stomps down on it. I have a different reason. I say your stockbroker gives you so much bull that you can't bear it anymore. But that's a difference. But you'll find out from the book what we think of the stockbrokers. So, the most important thing is the mindset of an investor in equities. The stock market is like a man walking up the stairs with a yo-yo in his hand. The whole key is to watch the feet and not the yo-yo. I want you to visualize that. Because if you are in the stock market, you need to keep this as your best friend. You should print this one out and frame it. Imagine a person walking up the stairs with a yo-yo in their hand. Your choice is, what are you going to watch? If you watch the yo-yo, you're not even going to know what the direction is. You can have such a sore neck from doing this as the stock market wildly fluctuates every day. You're not even going to know what direction it is. Watch the feet. Now, I'm going to give it over to John because this is his absolute favorite slide. Go for it, John. We have our favorites, and I'm definitely deferring to my son on
Thanks.
this one.
This is there are some slides we look at to sort of reinforce our discipline, because sometimes you need a compass, you need a north. So what this slide is from 1980 to 2023. If you just focus on the blue bars, which are overwhelmingly the top portion, it's the performance of the S&P 500 in each year. Average, just about 10%. It's on this presentation, average is, 10%. I'm not seeing here, but it is 10%. The orange line is the decline for the worst moment of each year. It's called technically the intra-year decline. From the worst moment of each year, that orange line indicates it. So if you look here, for example, in 1980, January to December, 26%. Worst moment of the year, minus 17. If you were the unlucky person who was misguided to sell at the negative 17%, you would have ended the year with a massive decline. But had you stayed the course, you would have clanked your champagne flute with a 26% year, and the difference is the cost of getting out. The average decline for the worst moment of each year is 14%. A decline of 14% in a given year of the S&P 500 is totally normal, 98.6 under the tongue. If it's less than 14% for the worst moment in each year, actually a very mild year, a stable year, not a lot of volatility. But look at this. There are years when it's down 49, 28, 34. Here you go. In 2020, down 34 for a moment, but it ended the year 16. And the spread was the cost of reacting, overreacting, misreacting. You want to come back up?
Yeah, that's fine. Okay, that's fine.
You got this.
Okay.
Yeah.
So what we tell people, and you're getting the drift here. You understand when I call us what we are, you understand why we, and by the way, we've got pretty good company. I want you to know, we sit on the shoulders of giants. That's why we're the tallest guys in the room. We're humble folk. Humble, not a single thing I've told you is original. Not one. You're not coming to us for me to teach you or John to teach you original thinking of RVW wealth. No, not at all. We know which are the high voltage outlets and we plug into those. That's our job. Take a look. Markets don't move up all the time. They move up over time. Now, I want to just tell you a point that Jonathan made over there, but I want to put it into Mungerology if I can, since our deceased chief rabbi passed away, and he influenced us very greatly. We all traipse up every year to Omaha to drink the well springs of wisdom from Buffett and Munger, and we'll see what happens this year, but it's always an extraordinary experience. Because you don't just learn about investing, you learn about life. You learn about how to think. And if you have some time, go into a YouTube and some of Munger's stuff that's come out now, and you'll find one of the deepest thinkers, most brilliant people who's ever walked the planet as far as we're concerned. But anyway, so what Munger says is, he says, anyone who's not able and willing to endure significant declines in their portfolio value every decade or so should stick out of the market and will earn the mediocre returns to which they're entitled. Because the mindset of a savvy equity investor, and this is a key word, is equanimity. Does anybody know what equanimity is? Let me tell you, it's an Oriental, Eastern religion concept, which basically, simply put, is feel nothing. The Western mind is trained to react. We listen in order to respond. We should be listening in order to understand and then develop a response, which is Steve Covey's great contribution in 7 Habits. The ideal way to listen, if you're serious, is to listen in order to understand and then to develop a response. But the Western mind, it looks at too many court dramas and thinks that you're a litigation attorney. You're listening in order to respond. That's not the way. If you want to live a meaningful life and have meaningful relationships, you have to interpose the third stage. First understand after you've heard, and then develop a response. So equanimity means feel nothing. Our society, as I told you, is about reacting. I look at something and I have an opinion. Does it look good? Does it look bad? Plastic surgeons. Every face you look at, you immediately think, and you should in your business. Not in my business. In your business, you should. You should immediately be able to react when you see things. But in the wealth management business, you must be able to look at equities and have no reaction. None at all. And here's the reason I tell people when they call. We've had quite a few calls now because we've had a terrific year. And people go, oh, Selwyn, we're so happy. And I said, please don't be happy. Please don't be happy. You know why? The happier you are, the more likely it is that you're going to put much more money into the market now. And I tell them, please, nothing about investing in the market should be done about your feeling of happiness. It should be done relative to your financial plan, which is the GPS of your entire financial wealth. These things have to be determined independent of whether the market's up or down. Please don't be happy. And when, of course, when they're worried about the market collapsing, I tell them, please, don't be sad. We are what we call counter-cyclical educators. When the market's going crazy, we're dousing the flames of hope. Please don't be too happy because you're going to react. You probably will end up putting money in. And by the way, also when the market goes down, which it does, we don't want people to be unhappy because they're most likely to pull out. Most people invest at the top, as you will see in a chart coming up. Most people invest at the top, sell out at the bottom because they can't stand the pain, and are trying to figure out why Buffett's wealthy and they're poor. And I'm telling you why. That's why. Because they react to their emotions. You know, I come from Africa, as you probably know. You go on safari, you watch the animals, and you learn a huge amount about investing. I'll tell you one of the things you learn. I'll give you a whole talk just on that, because I've been on safari many times. Just give you one. Animals, and we're all, as you physicians know, are bred with the same genetic impulse. Flee when you feel danger and herd when you feel comfortable. If you go into the wild safari, the veldt of Africa, you will see when animals are feeling safe and secure, they herd, they hang out together. And when they sense danger, they flee. That's what investors do most of the time. They're all happy to invest right at the top when all their friends are, market's doing great, and everyone's very excited, and they're pouring more money in, and they're getting in right at the top. The market blows out and falls down, and everyone panics. That's what animals do. And we do the same thing if we're not disciplined. So the key is suppress feelings, and this Oriental religious idea of equanimity. Feel nothing. No reaction. If the market goes up, the market goes down, no reaction, because your impulses will lead you astray. They lead you to buy when you should be selling and sell when you should be buying. Ignore them. They're your biggest enemy. Now, here's the problem with timing. Many people say, well, you know, if I could get in at the top and get out at the bottom, anybody read Rudyard Kipling's poem called If? That's the only use for if. So what do people do? Take a look here. Take a look at this example from 79 to 23. Right, you invested $10,000 just in the S&P 500, and you did nothing. 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 You didn't feel, you didn't react, you didn't buy, you didn't sell. You just did nothing, which most people have great difficulty doing. Nothing, by the way. Your $10,000 would have grown to $1.2 million. But if you were smart enough to pick 5 days to be out of the market, and they were the 5 best days, such a genius move, you would have reduced your gain from $1.2 to $758,000. That's more than half, just by missing 5 days. And if you miss 10 days, you get $546,000. If you miss the best 30 days, listen, the best 30 days out of what 50 years virtually there, 45 years. You miss the best 30 days out of decades. And your return goes down to 196, barely above the Treasury bill rate. Take a look at it. That's the danger of market timing. Because in order to get in and out at the right time, you need to make 2 perfect decisions. When to get out and when to get back. And if either of them is wrong, you've blown it. I have a good friend who's not a client of ours, very certain that he's right. Always wrong, but never in doubt. You know those kind of people. He called me in 2008 and gave me a lecture about why he was getting out of the dollar, which is dollar's garbage, he says, all rubbish, everything nonsense, the stock market's crap, everything this is going on with one of these tirades, and I'm putting everything into gold. Do you know how much that mistake cost him? Do you know what happened to gold between 2008 and now? Virtually nothing. Virtually nothing. And the stock market went up massively. That's the problem with market timing. Now, most people believe in active management. Active management is what most of the charlatans on Wall Street do. They know when to buy, they know when to sell, they know what to buy, they know what to sell. They're active managers constantly churning the portfolio. Take a look at how they do just compared to their own benchmark index. Take a look at the first one. And we don't make this stuff up. This is data. It's all out there. By the way, this is what Wall Street does for a living. This is what they do. They are active managers. Picking the right stocks, picking the right time, picking the right fund. Large cap, take a look. If you look out 10 years, you've got a 91% chance of underperforming the manager's own benchmark index. So why on earth would you pay a manager when you've got almost a virtually 100% chance of losing? 91% of them. So you've got a 9% chance of picking a manager who can get it right, and a 91% chance of getting it wrong. And by the way, this doesn't take into account the tax cost of active management. Part of the problem with it is that if you keep buying and selling, every time you have a gain, you have to pay tax to Uncle Sam. Well, to put it crudely, if I shave every day, I won't grow a beard. If you keep giving Uncle Sam his share every time you do a transaction of the gain, and the gains in short term could be 50% in California. So you can imagine, even if you're doing reasonably well, even if you pick the 9%, part of the 9% here, and you did better, after tax, you're still worse off. But take a look. It happens in large cap, it happens in medium cap, it happens in small cap, it happens everywhere. By the time you get to 20 years, you've got virtually no chance of beating the index. So why would you try? Why would you go with the charlatans on Wall Street? And by the way, we said this in 2000, well before 2008. People thought we were kooks. We knew what was going on. We understood it very well. We got a number of people in our office who come from the dark side. We brought them over into the light. We know what goes on in the large wealth management companies and the stockbrokers on Wall Street. By the way, they are not fiduciaries. I want to tell you something that's right in your field. When I was in South Africa, it was illegal for a doctor to own any share of a pharmacy. You know why? You know why. It was illegal for a doctor to own any share of a pharmacy. Do you know when you go to these Wall Street types, you know, I won't even tell you what I think of them because it's not in polite company. Just know that we call Wall Street the red light district of Manhattan. That's about the most polite thing I can say to you. And you'll see it in the book, written a little more eloquently. The problem is, none of them are fiduciaries. In other words, they can sell you their own products where they make a double hit. They can sell you products that give them different rates of commission. Now, everything is disclosed, but I made up a biblical saying which doesn't appear in the Bible, but it should. And it says, what the big print giveth, the small print taketh away. Doesn't exist in the Bible, but if the Bible was ever amended for financial purposes, I would ask them to put it in. So, of course, all these things are disclosed, but, you know, you need a magnifying glass and time to read 75 pages. But let me tell you, the first question I would ask my advisor is, are you a true fiduciary? And if they're a true fiduciary, and if they're not, I would get up and walk out right there. Right there. So now I want to tell you the problem with picking individual companies. This is the most valuable company list by decade in the world from 1980 to 2020. Take a look. There's nothing in 1980 that was there in 2000, and there's nothing in 2000 that was there in 2000. Well, virtually nothing that was there in 2000. That was still there in 2020. In other words, everything is too dynamic, too rapidly changing to buy anything as we used to in the old days. Everybody remembers you could buy Big Blue, IBM, put it in the drawer. Everybody remember General Motors. What's good for General Motors is good for America. You know all that stuff. Nonsense. You can't do it in 2023. There's no company that anybody could tell me they'll know will be around 10 or 20 or 30 years from now. Now, this is what I was trying to say earlier about investing with emotions. And I'm going to leave the stock market pretty soon, come to some other things, but everybody's buying here. Take a look at that cycle. Starts with being encouraged, confident, thrilled. This is where the maximum buying takes place, at the euphoric stage. And then everybody panics out over here. That's why the stock market over this particular period delivered 13.9%, but the average return of the investors is 5.5%, because they're not there for the ride-up. Now be careful of bubbles. What we did over here is analyze every bubble, and you know all these bubbles because you've lived through them. There was a gold bubble, which is the first one. Take a look what happens. There was a Japan bubble. Everybody remember? Japan had invented a new way to manufacture, just-in-time manufacturing. Everyone's copying that. Japan went into a huge prolonged recession. When these things go up, they often come down. Russia, everybody remember BRIC? The big fantasy thing. Everyone's got to buy the BRICS. Went to hell. Take a look at this. China, oil, everyone is Bitcoin. Every one of these has had their moment of glory. Take a look at FANG, what happened to them in 2020. In other words, what I'm saying is, flavor of the month is good for ice cream, not for your portfolio. Now, when you get to selection of stocks, the science, the data, the research shows that what you need to focus on is not stock picking, but attribute selection. Factor selection. There are what successful investment companies have is they possess common attributes. And the research has revealed about 10 attributes. I'm just going to deal with one, and I'm going to show you. This is the data that shows you that companies that pay growing dividends, and by the way, you should see that, dividend growers. You don't have to be a mathematician or a scientist or a wealth manager to understand that this category does significantly better than those over time. So if you can buy a group of dividend growers, you have a better chance of doing better over time than companies that don't pay dividends by historical standards. Now, fortunately, there are ETFs out there that's what they do, is seek these in real time. And they reshuffle the deck every quarter to make sure that your portfolio owns what are currently dividend growers and payers. And as soon as they cease paying it, they get kicked out. Not because of some Wall Street type decides to kick it out or some manager. We don't want managers. We like algorithms. We like rules. So the rule says if you don't pay growing dividends, you're out. And new companies that have paid enough growing dividends get included. So you have a Darwinian portfolio focused on this attribute or factor called dividend growers. And there are, as I said, about 10 of these factors. That's the way portfolios scientifically are computed. I now want to just talk about some diversifiers. These are not sales pitches. I'm not here to sell Blackstone. It happens to be a huge company. It's one of many that we use. This is simply an illustration of an approach. Everything here, by the way, is not considered investment advice. Nothing here is complete. I'm saying this because our lawyers make us. Everything needs to be done after you've reviewed the offering documents and consulted with your financial planner. Do not act on any advice given here. But take a look at this Blackstone portfolio. It's a $64 billion portfolio, so it's got size. It's since inception to date, it's an 11% annualized return, almost entirely free of tax, because real estate is tax beneficial. These same properties have a net operating income growth of 6%. Now I want to show you something that you probably don't know. The same fund, and I'll get into it in a little more detail, comes in 4 flavors. There's Class I, which is an institutional class. No sidekicks, no secret commissions. Not secret, I mean small print commissions, okay? That delivers 11.3%. But if you buy the Class S with the sales load, you only got 9.8%. And your broker got the difference. You could buy Class T, you only get 10. So if you buy this, you get the largest amount because there's nobody else sharing. None of your friendly Wall Street people are sharing. So you see the same product available in 4 flavors. Which one are you going to be getting? Take a look where they invest and what they do. Everything is gorgeous. There's no schlock. There's no garbage. They buy beautiful properties. This is an apartment house. This is an industrial warehouse. And this is a data center. Take a look at, and by the way, there are others. This is not the best necessarily. It's one of a group. But take a look at it. First of all, geography. It's where you invest, right where you want to be, in the Sun Belt, not in the Rust Belt. Property sectors. They mostly in what they call beds and sheds. Apartments, rental houses, and industrial warehouses. They don't have hardly anything in offices. They have hardly anything in shopping malls. That's not where you want to be. So they are geographically where you want to be, in the sectors you want to be, and they have a huge amount of fixed rate long-term financing and not much of it. $64 billion fund, 95% occupancy, 46% leveraged. It's very conservative. $114 billion of total asset value, and there you go on. I want to talk about one other category of investing, and then I'm going to let it go. There is a category that's come of age recently, and by the way, the real estate and this used to be, until a few years ago, in the hands of the institutional investors. They were not available to the public. But this is called private credit. Take a look at it. There's a company called Cliffwater, and I just want to show you what they do. First of all, it's a $14.5 billion fund, currently paying 11%. Their yield to maturity, 12.2, which is a more technical thing, but the actual distributions are 11%. They have 3,300 individual loans that you participate in if you're invested. Their top 10 positions only have 5.3%, which means they're very diversified. The average loan to value is 42%. which means very conservative. If the value, and by the way, they're all secured, first lien exposure, floating rate, which means that's how they got up to 11, because they keep floating up with the rates. Look at the size of the companies. Average EBITDA, which means the average earnings in the companies they're lending to, is $97 million. They're not lending to a corner bodega. So you see over here just two examples of how we take the core of equity investing and then diversify into other categories that represent less volatility, stable income, and they meet different needs. So the real estate is an inflation hedge and a cash flow generator. This is a cash flow generator, and the equities is both. So with that, I'm going to end it. It's a little more on Cliffwater. Thank you very much. I hope you got something useful.